Welcome to the deep dive. We're digging into Johnson & Johnson's Q3 2025 results today.
That's right. We're looking for the key numbers, the strategy, and really how they manage this massive drug transition.
Exactly. How did they pull off growth despite that huge Stelara cliff? Let's jump right in. So, the Q3 scorecard, the top line numbers looked, well, pretty solid.
Yeah, worldwide sales hit $24 billion. That's 5.4% operational growth year over year. Pretty strong.
But the bottom line, the earnings, that seemed like the bigger story.
Definitely. That's where the beat came in. Adjusted diluted EPS was $2.80.
Okay, and the forecast was?
Forecast was $2.76. So, a decent 1.45% surprise there on profit.
Revenue beat too.
It did, yeah. Came in just shy of $24 billion, $23.99 billion against expectations of around $23.76 billion.
So beats on both lines. And the reported net earnings, I saw a huge jump there, like 91%.
That's right. $5.2 billion reported net earnings, up 91.2%. Now, some of that is easier comparisons to last year, which was a bit noisy.
Oh, okay.
But the adjusted beat, that $2.80 figure, that tells you the core momentum is really there.
Right. Which makes the stock reaction a bit puzzling, doesn't it? It was up slightly pre-market, like 0.5%, but then actually dropped almost 2% during the day.
Yeah, that happens.
If the numbers were so good, why the dip? Was it just market noise or maybe something in the guidance?
I think that's exactly it. Investors often look past the quarter that just happened, right? They're focusing on what's next.
Forward guidance.
Exactly. The headwinds, the costs, maybe that tax rate news we'll get into. That nervousness, it can overshadow a good quarter sometimes, even with execution this strong.
Okay, let's unpack where that growth actually came from. Seems like both big divisions did well, innovative medicine and medtech.
Yeah, that's really the impressive part. Both grew nicely. Innovative medicine up 5.3% operationally, and medtech actually a bit stronger, 5.6%. And this is key. They did this while absorbing huge internal pressure.
Right, let's talk about that pressure. The Stelara situation in innovative medicine, that was the big worry.
It really was. Okay, so innovative medicine sales were $15.6 billion. Good number.
Uh-huh.
But that 5.3% growth includes the massive hit from Stelara.
Yeah.
Sales for Stelara dropped 42% worldwide.
42%, wow.
Yeah. Biosimilars hitting, changes in Medicare Part D. It was expected, but still huge. That single product loss basically created a drag of about, get this, 10.7 percentage points on the segment's growth.
Wait, so if Stelara dragged them down by nearly 11 points, but they still grew over 5 points.
Exactly.
That means the rest of the innovative medicine portfolio grew almost 16%.
That's the math. It's pretty remarkable execution. Shows the strength of the newer portfolio.
Okay, so who are the heroes stepping up? What filled that gap?
Oncology, clearly the main engine here. Operational sales in oncology jumped almost 20% in Q3.
20%, okay. Driven by...
Well, the big one, Darzalex, was still strong, up almost 20% itself. But the exciting part is the newer stuff. Like CAR-VYKTI, their CAR-T therapy. That shot up over 80%.
80%?
And the lung cancer combo, Rybrevant, Elduzi, grew over 100% operationally. Shows they're really pushing into these high-value targeted cancer treatments.
Yeah.
Shifting from volume to value. Makes
sense. And immunology, that's the other big focus, right?
Absolutely. Trem FYA, which is pegged as the Stelara successor, put up really strong numbers, 40.1% operational growth.
40%. What's driving that?
Market share gains, plus the new launch in inflammatory bowel disease, IBD, that's helping a lot.
Okay.
And in neuroscience, another area they're pushing, Spravato grew over 60%. Plus, Caploplyta, that depression drug they acquired, that brought in $240 million this quarter.
So, strong performance across the board in innovative medicines ex Stelara. What about medtech? 5.6% growth is solid there, too. Was that mostly acquisitions?
Acquisitions definitely played a big role, especially in cardiovascular. That subsegment shot up 11.6% operationally.
11.6.
Yeah, powered by Abiomed, which was up over 15%, and Shockwave up nearly 21%.
Oh, those big recent deals.
Exactly. Plus, their core electrophysiology business grew almost 10%. But what's also strategically important is orthopedics.
Which had been struggling a bit, right?
It had.
Yeah.
But it returned to growth this quarter, 2.4% overall. Hips up 5.1%, knees up 5.6%.
Modest, but positive.
Right. And that return to growth gives them, flexibility for what they announce next.
Okay, let's shift to that forward view then. They raised the sales outlook for 2025, which sounds good.
Yep.
But they kept the adjusted EPS guidance the same. Why bump sales but not profit?
Ah, yeah, that caught people's
Stuck you.
attention. It boils down to taxes, basically.
Okay.
So they did increase the sales guidance midpoint to $93.7 billion. That's about 5.7% growth for the year. Pretty good.
Uh-huh.
But the adjusted EPS guidance midpoint stays at $10.85. The reason? They're expecting a higher effective tax rate now, between 17.5% and 18%.
Why higher?
Mostly due to that One Big Beautiful Bill Act, the recent federal legislation. It hits how overseas earnings are taxed. So better operations, more sales, but taxes take a bigger bite, netting out the EPS gain.
Got it. So external factors are capping the profit growth a bit, despite strong performance. What about looking further out to 2026?
Now, that's where they sound really bullish. They're saying total revenue growth in 2026 should exceed 5%.
Exceed 5%. What's the consensus estimate?
Consensus is currently around 4.6%, so they're guiding above the street.
And this is despite Stelara continuing to decline.
Exactly. They expect that continued erosion, but they believe the ramp up from new launches, Trem-FYI and IBD, Rybrevant Lazcluze, and this new drug Inlexo will more than compensate and actually accelerate growth.
That's quite a confident stance. It lines up with what the CEO said about M&A too, right? Something about not needing big deals.
Yeah, he specifically said J&J does not need large M&A to deliver in the high end of our growth targets.
Reinforcing the organic pipeline story.
Pretty much saying our internal engine and recent launches are strong enough.
Okay, but hold on. If they don't need large M&A, they just spent billions on Biomed and Shockwave, didn't they? And you just said those deals are powering the medtech growth right now. Isn't that a bit contradictory?
That's a fair point, a really good point, actually. I think the key word there is large.
Okay.
Maybe they mean they don't need another multi-billion dollar company transforming merger. What they have been doing is very targeted, strategic, maybe mid-size or tuck-in deals.
Like Biomed and Shockwave.
Exactly. Deals that fill specific tech gaps or accelerate growth in priority areas like cardiovascular. So it's not no M&A, it's just perhaps a different type of M&A. Focused strategic additions alongside their, $15 billion internal R&D pipeline?
So building the foundation internally, but using targeted deals to accelerate or enhance.
That seems to be the strategy, yes. Building, not just buying, their future growth.
That focus on optimization kind of leads nicely into the other big news, the plan to separate the orthopedics business, depresynthase.
Yes, that's a huge move. They're planning a tax-free spin-off, likely over the next 18 to 24 months.
Why do that now, especially when you just said it returned to growth?
It's about sharpening focus, continuous portfolio management. Ortho is a solid business, but it's generally slower growing and more capital-intensive than, say, cardiovascular or their advanced surgery platforms.
That's right.
By spinning it off, the remaining medtech portfolio, CV, Surgery Vision, gets an immediate boost to its growth profile and its operating margin. They expect at least a 75 basis point improvement on both metrics right out of the gate.
So it's trimming the lower growth branch to let the higher growth ones flourish even more. Classic portfolio shaping.
Precisely. Focus resources, focus capital, improve agility. It makes the remaining company profile look more attractive from a growth perspective.
And we're seeing innovation coming out of those focus areas, right? Validating that strategy.
Absolutely. The pipeline is delivering. Let's hit 3 quick examples that really underscore where they're putting their bets.
Okay, start with oncology. There was a big approval.
Yes, Inlexo, FDA approved. It's a first and only drug releasing system specifically for high-risk, non-muscle invasive bladder cancer.
Drug releasing system, not just a drug.
Right, it's a targeted delivery mechanism. And here's the kicker. J&J thinks this single localized treatment could hit $5 billion in annual peak sales.
$5 billion for a delivery system.
That's the projection. It shows the potential they see in moving beyond just traditional systemic drugs into more targeted approaches. Huge potential.
Wow. Okay, what about immunology? Helping that Stelara transition.
Couple of things there. Trem-FYA got U.S. approval for subcutaneous induction in ulcerative colitis. That makes it the only drug in its class, an IL-23 inhibitor that has a fully under-the-skin dosing regimen for both UC and Crohn's. Easier for patients.
Convenience matters here.
And they also submitted a new drug candidate, icotrokinra. It's a novel, targeted oral peptide for plaque psoriasis. An effective pill for psoriasis could be, a game changer.
A pill instead of injections, huge difference. Okay, and one more, medtech innovation.
Yeah, this one's really compelling. Data from the Impella CP heart pump that came from the Biomed acquisition.
Right.
Landmark data from a big study called Danger Shock. It confirmed a long-term survival benefit for patients in cardiogenic shock, which is incredibly deadly.
How much of a benefit?
It showed a 16.3% reduction in mortality compared to the standard of care. Patients lived, on average, 600 days longer.
That's incredible, actually saving lives and extending them significantly.
Exactly. That's the kind of high-impact, high-value innovation they're betting on, especially in that prioritized cardiovascular space. Hashtag outro. So if you pull it all together, the message from J&J this quarter is pretty clear. They feel they've successfully weathered the immediate storm from Stelara losing exclusivity. They believe they're entering what they're calling a new era of accelerated growth. And that confidence seems built on the performance of these newer brands and the strategic acquisitions they've made.
Right, they navigated the handover. So here's maybe a final thought for you, the listener, to consider. J&J is clearly betting on focus and agility now, spinning off ortho, doubling down on areas like oncology and cardiovascular, using targeted M&A. They're confident enough to predict growth above consensus for 2026. So the real question isn't just if they can grow through this transition, they seem to be doing that.
Right.
It's whether this big strategic move, the ortho spinoff, will actually unlock enough management focus, enough capital to really fuel the next wave of those billion-dollar life-changing innovations like Inlexzo or Impella. Is this just step one in an ongoing game of strategic refinement?
That's the multi-billion-dollar question, isn't it?
It is indeed. That wraps up our deep dive into J&J's Q3 and their strategic path forward. Thanks for joining us. We'll catch you on the next one.